Well, good evening and welcome to Keystone's presentation of Buy, Improve, Grow, and Sell. It's a proven process that we developed over the years that we'd like to share with everybody. We want to first thank our host, Environmental Consultant and Affiliates Network, for allowing us to use their training room. So if you see all these different items around, the reason for that is if you wanted to know anything about mold or radon or lead, asbestos, they teach that here in this classroom. Again, we want to thank them for sharing the room to allow us to make the presentation this evening. So why bigs? What's the big deal, if you will? The big deal is, how do you as a business owner find the time to focus on your business? This is a strategic process where we're not just working in the business on a routine basis, but in fact are using the ownership and key management players to assist in exactly what the title says, either to buy, or if you've already owned something, to improve it. And once you've improved it, very oftentimes we hit ceilings where we can't break through to the next level. That's the growing process. And then ultimately, a business is something we can't take with us at the end of our life. So we must find a way out, whether it's to sell or if we're going to succeed, transfer it in multiple ways. Today's effort is going to focus on the sale of the business. We have a different presentation on the exit planning that would talk about succession. And as we have that available, you'd be more than welcome to join us for that as well. So with that, we'd like to go ahead and get started. First of all, I want you to know a little bit about Keystone Business Ventures. We do 4 basic things. Charlie, someone just hit the door up there. We provide certified business valuations. We do certified machinery and equipment appraisals. We also provide strategic merger and acquisition advisory services, and we help with commercial real estate investments. We find that collective capability allows us to assist business owners as they pursue this process of ownership and establish a relationship, not just at the time they buy it, but throughout their entire ownership life cycle. The idea being that if we know the business better, we can work with you and provide you the different type of information, consultation, and advice necessary to accomplish the goals that you intended when you made the initial acquisition. At the same time, we know that those goals change for many different reasons, and we want to help you with any adjustments that you might need to make along the way. So those 4 main items are going to be leveraged to help you accomplish the goals that you're after. So let's first talk a little bit about ownership and how successful they are as owners in transitioning this selling process. Very, very key important thing to understand is that 70 to 80% of the businesses that are on the market never sell in any given year. There are lots of reasons. We're going to highlight some of them. But this is the number one obstacle that you have to understand. And that is that, wait a minute, you're telling me only 20 to 30% are successful at selling each year. And that's the truth. Statistically, this has been measured. Our reference here is Tom West in his business reference guide, where he tracks transactions of businesses annually and has an annual publication. So we utilize that to help and assist us. Also, we also know over the last 12 months, those that were successful, that 20 to 30% that were able to sell, 3 out of 4 profoundly regretted the transaction. The number one reason for that regret is that they did not have a plan of what to do next. They may not have been prepared for the tax ramifications. If you think about this selling of the business, all of your money that you have that's tied up into it is suddenly going to come to you at one point in time. What do you do next? How do you protect it from taxation? How do you set yourself up for whatever might be your next adventure? Also, we find that from fellow M&A people, the highest reason that 70 to 80% statistic stays so dominant is the fact that business owners have a very unrealistic expectation of what their selling price should be. They don't understand the market. They don't understand the economics around the transaction. And it's very important that we provide you with a clear understanding of the market, the transaction elements associated with it, the difference between the buyer perspective and the seller perspective. They have to overlap a little bit in order for us to be able to make a transaction. Without that, we're stuck with that 70 to 80%. Also in the field, we have a large number of family-owned businesses. The statistics aren't any better for family-owned businesses, quite honestly, than they are for individually owned businesses. The fact still remains, when you get from one generation to the next, to the third, and down to the fourth generation, you're going to have only about 3% continue on, or roughly 1 out of 1,000 businesses get to that fourth generation. We also know that along the way, throughout the ownership, there have been many studies done, one by Rob Slee, who has annually made publications, and what he is coming up with the capital markets of privately held businesses. That's the small business owners of America, and is saying they have significantly generated less returns on their investment than what they should have. What does that mean? We have a tendency, I think, to incur expenses rather than to pay dividends or make distributions, and therefore the return is somehow absorbed, either through a lifestyle payment, or you might be buying something just to depreciate it. For example, you may not need a new vehicle for the business, but you buy one anyways. You trade in, you get the higher value for the newer vehicle, and you then suddenly depreciate it all off at once. The opportunities like that, they're there, considerations you make, but did they consider making a distribution back to themselves, returning the money on their investment? Because at some point, you may incur a downturn, and you may not be able to get that distribution out. That opportunity may be foregone and never repeat itself, especially if, unforeseen circumstances happen and the proverbial bus comes along and you're no longer able to operate inside the business. You're not going to get the return on the investment. Okay. We also need to understand the climate mix of ownership that's out there right now. It's dominated by baby boomers, people in my age group. Okay. What you have to understand right now is back in 2011, my age group began to turn 65, and we are generating about 10,000 baby boomers reaching that magical birthday per day, every day. Say, okay, well, that's nice. What does that mean? Well, the youngest right now are 59. So they are becoming retirement eligible, and they may be considering early retirement at this point. The issue that we'll talk about a little bit is this economic backlog that has happened. If you go back all the way to 2008 to present, business owners have been hard pressed to get 3 to 5 good years in a row to make improvements over time to optimize their return on their investment by taking the business out to market. The other thing to keep in mind is How many small businesses are owned by those baby boomers? Back in 2013, they comprised roughly 63%. 2 out of 3 businesses almost were owned by baby boomers. And if they haven't been able to sell, there's a backlog. Now, if you're not a baby boomer, but you are a business owner, and you're going to go through a normal ownership life cycle of 7 to 14 years, typically 2 economic cycles, before the time you buy to the time you sell, you're going to be competing with this backlog of people that must get out. The other thing that you have to understand is business owners tend to have tied up about 80 to 90% of their wealth in the business. This is very important, particularly with baby boomers who the next adventure is retirement, and they need to resource that retirement. How are they going to pay for things if they can't get the cash out of the business, if they become that 70 to 80% statistic? At the same time, you need to know that over the next 10 years, 75%, 3 out of 4 of 2/3 of the business owners intend to exit. They're going to get out. Further understanding the statistic also is that you've got 48% of them plan to be out in the next 5 years. So half, or 1/3 of the businesses owned, are going to change hands. What does that account to? Well, it's about 4.5 million businesses, and they have a value of close to $10 trillion. Not billion, trillion. So there is a large amount of transactions that need to take place. The observation that we have from Keystone is, we really don't have in the following generation a 1-for-1 head count to replace every business owner that looks to transition. Ergo, merger and acquisition. The merger side may become more and more important, and the preparation for that and the attractiveness that we need to generate so that we can, in fact, become a viable candidate for an existing business to either absorb us or bring us into their operations and operate the business with a single management ownership structure. All right. Having said that, giving you the background that says what kind of competitive environment am I in, both economically and within my market and industry, what am I up against if I'm thinking about going through this process? What we want to talk about is the BIGS program and why it is so important that you follow a proven process that we're going to identify to ensure that you increase the chances. There's no guarantee, but you increase the chances that you're that 20 to 30% that do sell, and you want to be that 1 out of 4 that is satisfied with the transaction. Very important. Very important. In the BIGS process, we're going to talk a little bit about a benchmark analysis and how is that important to you and why is it a starting point. We're also going to talk a little bit about preparing for that offer that you can't refuse. Is the building of a confidential business profile or a seller's memorandum, marketing material that would be utilized to engage either a targeted buyer or someone that's targeting you so that you're prepared and able to talk to them and demonstrate a little bit of information about your particular business sufficient enough that they decide that they're willing to do due diligence to see if you're a proper fit. Okay? Whether that's an outright acquisition, one buyer, one seller, or if that's a merge, an existing company coming down and buying your business and incorporating your business into theirs or their business into yours. We also need to talk about this concept of SWOT, strength, weakness, opportunity, and threat assessment. We need to understand how our particular industry and the economy, where do they fit? Are we in an industry that's growing? Are we in an industry that is in line with the economic growth that takes place? Or are we at one that is declining? Have we gone past maturity? And therefore, our attractiveness may not be as great, because all of that affects what we can do to go through that buy, improve, grow, and sell process and still be successful if we understand that not all industries are the same. Some are more attractive to others. At the same time, we need to also talk about how we utilize the entrepreneurial operating system to make sure that all of our people that are key to our business understand the direction that we're headed. And we have some philosophical pieces that I think we need to overcome. And that is the fact that it's not a bad thing for a business owner to talk to people inside his business about how he's going to transition from the perspective of sustaining the business into the next ownership cycle, meaning the employees will still have a job. You're not going to close, turn out the lights, and go home. We need to make sure that that all happens and that we communicate that. We'll talk about that in a little bit more detail. The other part of this process that we follow is a review and analysis. The review and analysis is going to see where your particular company stacks up against its historics. Excuse me. I forgot to turn that off. Sorry about that. In a review and analysis, we need to understand how your company stacks up against itself historically, where you fit within your industry, and where your company fits within the economy, the areas for which you impact. It may just be your own little neighborhood. It may be the municipality that you're in, maybe the county, the state. It could be a region, or it could be the whole United States, or you could be global. Whatever it is, you need to understand where you're at in that market and how you're progressing. At the same time, you need to be looking at the value for which your business would trade at. All the decisions that you would make from the benchmark analysis, the decisions that you would make in a confidential business profile, or through the SWOT and through the ESOS process would also be part of a triggering event. And that is, simply put, each 90 days, do I continue to improve and grow, or do I sell? At the same time, we need to understand a little bit about the M&A sales process, because all of this that we're talking about should lead to a successful end and not regretting that end once it happens 12 months later. All right, let's first talk a little bit about what do we do with a benchmark, because that's step one. The obvious reason for that is to understand a little bit, if I took my business to market today, what would I expect as an asking price and a sale price? And they're different. What you ask and what you receive are different things. And understanding also, we've gone through a lot of transition most lately. We had a long period of time where interest rates were extremely low, 3% or lower. Now we're in this 6% market time frame. What does that mean in terms of your ability to command a price when you ask for a certain value? Well, when we were at 3% and the money was borrowed, there were more operating dollars in a future cash flow that a buyer would anticipate having, so he could afford to pay you more. But if he is being set with higher interest rates and in a time frame when we have higher inflation, so his costs that he incurs, he may not be as efficient as you were previous years until he gets his pricing readjusted to compensate for that. And that can be very hard in a rapidly changing environment, which COVID did, not just to us here in the US, but throughout the world. So when we're going through this process of building a benchmark for clients, one of the key metrics that we provide is a price to sales and a price to EBITDA. You have to understand that every business, when it sells, they sell within a range in a particular industry. That range can be $1.50 to $3.50, for example, of sales. It could also be $1.50 to $3.50 of the earnings before interest, taxes, depreciation, and amortization. It is a earnings measure that is used much like a cash flow to see what the business could afford to pay for itself, to pay the owner a salary at market, to cover any kind of capital expenditure, new equipment that needs to be bought, and to make sure there's adequate working capital, plus what Rob Slee came up with, a return on the investment. We'll talk a little bit more about that as we go through. This idea that every business will trade at a certain value. This is a value for ranges for restaurants, and they are arranged here showing in the far right two columns, the price to sales and the price to DE, discretionary earnings. Okay, that is the earnings before interest, taxes, depreciation, and amortization, along with one owner's salary. If you look in the middle, you'll find a mean, or the average. The price to sales is $1.28. For every dollar in sales, they sell for $1.28. The price to earnings is $4.60 for every dollar of earnings. Okay, thinking about an income statement, at the top you got sales, right? Then you got to take away the cost of goods to get to your gross profit. Then you take away your general and administrative cost, and you get down to your net income, and then you pay taxes, and then you get into your net income after taxes. So a typical process then is sales. They're the dollars that are being used for that $1.28. But at the same time, you're going to have $4.60. So what kind of profit after taxes should we be looking at? It's almost a 4-to-1, right? So should my profit margins be structured that in this particular industry that they should be earning somewhere around, before taxes, this 25%? And if you're not pricing your business on your menu to allow you to get to that, you're giving it away. You are what Rob Slee found in his annual surveys, that we are not charging enough for our services and goods that we provide to allow for that return on investment. The benchmark also helps the seller to develop any kind of improvement or growth plan. When we look at things, we might find where there's some inefficiencies or some things that we could better improve. And if that's the case, then we need to go ahead and make some kind of adjustments to make the business more attractive and have the earnings keep pace with the sales, right? Yeah, if you think about what we talked about, this fit in between the price to sales and the price to seller's discretionary earnings, it's pretty easy to understand that, oh, wait a minute, if I use this concept of a loss leader, I grow sales, but I don't necessarily grow any earnings because I'm giving away something free or nearly free to get the new customers in. You can do that for some period of time as long as you have a transition plan that you are going to eventually get a greater amount of earnings with a larger customer base. So if you grow the base and then increase the earnings later, then you accomplish the goal of that growth, of breaking through the ceiling, getting to that next level. It also helps you develop a keen sense for the market impacts that are out there. How do you affect value? What decisions do you make on a day-to-day basis that will affect the value of your company? And it's understanding that it's not just value in your eyes as a seller, it's the value in the eyes of the buyer. When those things have an overlap, we can get a deal. If we don't, we got a disconnect. We're back at that same statistic, 70 out of 80% not able to sell. Okay, a couple of things that we want to understand about a typical business model. First of all, most small businesses, when we sell our assets. We do not sell the stock or the equity interest in the business. Those asset sale transactions are normally done and include that the buyer will get the inventory at cost, furniture, fixture, and equipment, and goodwill. He does not get the cash, accounts receivable, or payment for the liabilities unless there's specific adjustments made in the agreement for those purposes. The asset sale normally excludes that. That's why when you value your business, you have to account for working capital, because when you sell, you're keeping all the money in the checkbook. You're keeping the accounts receivable that close the day before you sell. That all comes to you. You also have to pay all the bills that come in through the day before you sell. They're yours to pay. But that cash is gone. It's no longer in this system. So cash needs to be put into the system at the top. That working capital then has to go out and either purchase the labor for services or to improve product inputs and raw goods to produce something. Once it's produced, then it has to sell. Typically, in this credit-oriented world, then we may have to have an accounts receivable. Those items that we purchased and paid for, that labor that we paid for, those sales that we recorded, we don't have the cash yet. We've got an accounts receivable. Ultimately, that accounts receivable comes in and we get cash. Then we have to do one of two things with it. Recycle it back through, turning the crank. And the faster and the more often we can revolve that crank, the more dollars that are available to go over to our overhead, our general and administrative expenses, and then ultimately down to making those dividends and distributions to the people that invested in the business, you, the owner. This concept of trying to understand about the enhancing the cash flows, getting that crank to turn over faster and faster, really has a lot of things that we have to think about. These concepts of cross-selling, upselling, expanding product lines, they are all designed so that you can increase that crank and turnover of the cash that you invested. At the same time, we have a requirement to see if we can't get our cash faster, get it back into our pocket. There are a lot of systems out there today that when you sell things that don't create a true accounts receivable, they create a thing called like PayPal. So when they go through and they purchase a product or a service, you may be paid by a credit card or debit card transaction, except what you sold that for has a charge. You know, right now, 2.5 to 3.5% on most transactions to even accelerate the cash that you will receive in 1 to 3 days, shrinking the time that you would hold an accounts receivable or the potential risk that you won't be paid at all. Although you have to be very careful because some charge cards and debit cards, if they say, hey, this isn't what I want, they'll have a clawback capability. Those of you that use those systems understand exactly what I'm talking about. So it's very important that we understand how this system works and how we can plan to impact to accelerate and enhance that cash flow. All right, we're ready for a break, but before we move on to that, what I would like to do is offer you the opportunity to receive a written portion that pertains to a lot of the things that we talked about. We have prepared a financial introduction to financial management. If you would send me your email address, we will email that off to you. It's about a 30-page piece that's going to talk a lot about the details of understanding the nuances of how income statements, balance sheets, and how we measure ratios and how we can improve our particular company as it relates to our history in the past, as it relates to the industry that we're in, and the economy that we're in. So we're going to take about a 5-minute break. If you would, please send me an email. If we don't get that responded back to you tonight, by tomorrow, we'll definitely get that out to you. Thank you, and we'll be right back. Hello, once again. We're going to go ahead and get started. Again, if you haven't already, please send me an email and we'll send you an introduction to financial management. It's a short 30-page manuscript that explains in detail, a lot of the financial and strategic information that we talk about, this risk assessments that we need to make that'll be coming up in the remaining portion of the discussion here today. All right, so let's continue. The confidential business profile. What do we do with a confidential business profile? First of all, we have to understand that it's used to attract a buyer to make a decision. The decision is whether to invest their time and their money on due diligence on your business. So there has to be sufficient information that tells them who you are and what you do. Normally, these are confidential, as the name implies, so there is a non-disclosure agreement or confidentiality agreement that's signed before this information is released. I understand very well that just because you've got an NDA signed, will people talk and blab and all that kind of stuff. The only thing that I could tell you is if we have to go after somebody through a court of law, having that documentation is the best thing to be able to prove that we've incurred loss and that they were the ones that caused that loss. The other thing to keep in mind is that we also want to be focusing on the long-term profitability of our particular industry, right? So we need to go through and be able to assess our strengths so that we can take them and either apply them to weaknesses that we have or opportunities that present themselves. And we will use a strength if, in fact, we have a threat. And that threat is going to put us out of business. It's a major magnitude impact. If that threat is out there and it's in the near term, that 2 to 5 year period, we need to start to do something about it. If that's a threat that's out there that's going to be 10 to 20 years, once upon a time, we used to talk about technology being such. But now with the rapid increase for which technology is advancing, those timelines are shrinking and may be here in that 3 to 5 years. And we need to understand what's happened to some of the industries. The other thing is regulations. You know, if you were a coal miner, you may most recently have read in the news, a lot of those operations have been shut down. And it's been shut down because the regulations have been enforced at such a high level that the small business owner can't afford to operate. He can't meet the requirements and make a profit. So therefore, he goes out of business. So this concept of a SWOT assessment that's trying to understand about the long-term profitability of the industry that you're in is an assessment that you make with the idea of, do I stay in that industry or do I have to reorganize into an industry that might be more profitable, that would be better for me and for my investments that I have made thus far? At the same time, we also have to understand that this is a competitive environment, this business field that we're in. So how competitive is our company within the industry? Where do we fit? Are we in the bottom quartile? Are we in the 2 middle quartiles, an average business? Or are we a premium type business and we're in the upper quartile, the top 25%? Every business has an opportunity to be somewhere in that array. The key here is to understand where we're at, and we're going to talk about ways that we can assess that and understand that information. Okay, in the SWOT analysis, what we typically work our way through is this red we want to avoid, if at all possible. The only thing that we have is to take strengths and either deploy them to opportunities and grow the strengths, or shore up weaknesses and convert them to strengths so that we can combat the threats in the future. Okay? That's the process that's done in this assessment. It's nothing more complicated than that. They talk about doing the strength mapping. Well, that's this same decision base that you make to talk about whether you take your strengths and align them with opportunities or shore up weaknesses so that you're better able to combat the threat if it's marching forward at you. Most of the growth industries that are still growing, they're growing because they do not have a foreseeable near-term threat. Those businesses that have matured may be subject to technology, regulation, whatever. They tend to have that threat maybe at that front door near term, and they need to be able to understand that and see what you're going to do. Keep in mind that we have had mature businesses, industries stay mature for an entire century. Okay? So it's a difficult assessment to make, but you still need to make that call. Okay. What kind of threats might we have to face and think about? Well, this concept of new entrants. The guy opens up next door and does exactly the same thing you are. He's a competitor, except you own one building. He bought the entire remaining portion of the block. So now what's he going to do? Is he going to attract more people than you will? We also have to understand when we're out there and we have our services and our products, we have to deal with the buyers. But they're also looking for leverage. Simple things like they come back in and we've talked so much about the baby boomers. There are buying services, the AARP as an organization that provide discounts to seniors as they join that organization when they make purchases. We also have a number of these different warehousing clubs that you can be part of. The Sam's, the Costco's, the BJ's. They're all out there and they give us purchasing power as a buyer over and above what we would have by ourselves as an individual. So we have to recognize in the marketplace, what are we offering and what competition is out there. The threat of having substitutes. This is really something that I think is very, very important when you think about not too long ago, we used to dial on the phone with a rotary, right? And everybody, every home, every business, every desk had a rotary phone. Now we carry this thing in our pocket and you can't find a rotary phone anywhere. That substitute is now here and has replaced all of those that were in existence since the beginning of the telephone in the United States. Also, we have to recognize this concept of the suppliers and their ability to give us good purchasing opportunities so that we can compete in the marketplace. We have just recently gone through with COVID tremendous disruption to the supply chain, and some of that isn't fixed yet or is subject to start-stop or is feeding this inflationary cost because there was a short supply and that supply hasn't caught up with demand yet. So we've got price escalation because it's a competitive environment. We have yet to reach a new equilibrium between supply and demand to make that work. All right, so understanding how all that works, then you have to also keep in mind that you have your investment, your capital, you're deploying that in a specific industry. Is that the best bang for the buck for you? If that capital is deployed where your knowledge, skills, and ability align with it, it's probably the best you can do. But if not, is there somewhere else that you should be? Case in point, I'm operating a popcorn stand in a small park, right? And I'm selling popcorn. But I also have a medical doctor's PhD degree and I'm licensed. But I like selling popcorn. But could I make more money if I was a surgeon somewhere in a hospital? Chances are, maybe. And I'll tell you why. I once observed a popcorn vendor. We happened to be in Boston at the time, down at the Commons, if any of you are familiar, where the Boston Marathon finishes. Just across the street is a pond, and that's where this popcorn vendor was. I watched him when nobody was there buying popcorn, nobody was looking. He pulled out his wallet and he thumbed through, and I seen him counting his money. He got to a certain number, he closed the hasp, put that back in, he took the popcorn machine, turned it off, he took the popcorn, he threw it out for the birds to eat, and he went home. It was only 11:30 in the morning. He made more than he had expected for that day and said, okay, I can't get more efficient than what I am, and he went home. That type of lifestyle may be attractive. So it depends upon the business, and you have to understand that. So that's why that knowledge, skills, and ability aligning with the investment and the lifestyle, the balance, has to be taken into effect. Okay, so that industry rival is all tied in to that particular model. The confidential business profile also defines what your goals were for you and your organization so that you can accomplish the tasks along the way of improving, growing the business, getting it to a mature, sustainable, profit-making enterprise. When you do that, then you are probably approaching that point to say, I've got this sustainment, that every 90-day decision that says, do I sell or do I continue to grow and improve? We use this EOS system, entrepreneurial operating system, also as a pulse mechanism. Certain metrics that get identified. How well am I progressing? How well are my people progressing? Do I have a vision? Within that vision, do I have certain goals? Have I taken those goals and I have handed those off to key individuals inside the organization? Do they know what those goals are? Do they know how those goals fit in the overall vision? So that everything is clear. This concept that we got on the bus, the right people in the right seats going in the right direction. Okay? If that's the case, then we're doing this correctly. If not, we need to make some adjustments. All right. So this concept of the EOS ties together not only that long-term vision, but the information that we get, the data. Okay? What's that data on? Well, wait a minute. We just talked about in the SWOT assessment concept about buyers. We talked about the suppliers. We talked about the new entrants into the business realm that we're in. We also talked a lot about our internal and external capabilities, right? In the SWOT assessment, when we talk about our strengths and weaknesses, principally we're looking inside the business. How did we do against ourselves in the past, in the future, and where are we in our industry fit, right? In our particular given market. When we go beyond that, we look externally and we took a look at our opportunities and our threats, we're outside of that and we're looking in a more larger potential area for us to operate in, as well as potential threats that could harm our business opportunity. In that, we also know that every business should have a set of steps. BIGS. We talk about our proven process steps that we use. That's what this presentation is all about. Those are Keystone's processes. You need processes inside your business that are clearly understood not only by you as the business owner, but also by the people that work for you and the people that you actually do business with, suppliers and buyers. They need to understand what you can do for them. We talk about people having the right knowledge, skills, and abilities in the right place doing the right job, and they know what they're responsible for and how it plays in that overall vision. When we have things that get disconnected, we have this issue called issues, right? The thing called issues, excuse me, issues called issues. My tongue is tied. When we have issues, they're there so that we can capture something that's not working, and we go about developing a means to make improvements so that we do not stall our ability to improve and grow, as well as improve the value, therefore accomplish the sales goal that we're ultimately after. The traction that this thing talks about is that pulse of everything going all in the right direction, making sure that everybody that has a responsibility that is defined in here as rocks are making progress, are resourced properly to make that progress, and are integrated with progress of the other people around them. So everybody is feeling that they're part of the growth, not somebody just sitting over there on the sidelines. They have to be all fully participating because they want to be part of it and they're capable of being part of it. All right. The review and analysis also is going to compare this at the company level, industry, and the economy. We're also going to look at how do we come up with improvements and growth. Well, we do that really through three main tools. Obviously, some sort of sales forecast, right? We're at X, we want to be X plus. Then how are we going to go about doing that? What sort of internal data do we have? What kind of process do we have? Who are the people that are going to help us get there, right? And what issues must we overcome in our marketing plan that integrates the supply side along with the buyer demand that we're attempting to service or provide products to? Ultimately, while we're doing that, we must have a cost control plan. The cost control plan is keeping those general and administrative costs and cost of goods in line with the sales so that our price to sales metric and our price to EBITDA metric are tracking upward and are getting the same value as we grow the business. It's important that all of those pieces be integrated. We do this through a repetitive strategic process. That strategic process is taken right out of the publicly traded companies. Publicly traded companies every quarter have to publish a status report, a review and analysis of where they are. We have taken some of that and developed that for small business. We don't have all the resources that they do. I don't expect you to have access to the information. That's why you have me. I have that information, and we're going to work with you so that you can comprehend it and apply it just what you need, nothing more, for your particular business. So we're able to go ahead and compare you to yourself over time, as we said, to your industry, and to the economy. When we do that, that's through the development of a sales plan, a marketing plan, and a cost control plan. Three different focused elements, but they're all working towards improving the value over time of the business. Notice I didn't say improving the products or improving the service. That's implied. If you improve the products, improve the service, then you're going to improve the earnings. The earnings and the sales will affect the value. We also need to get used to this pulse that we call this every 90 days getting together and re-looking at one major thing. And we talked about it, this concept. Where am I on the buy, improve, grow, and sell progression? Am I there yet? Do I decide to sell or to continue to improve and grow? You need to be making that judgment, because part of that is to understand, if I did it today, if I pulled the trigger to go to market, What would my asking price be? What would my selling price be? Well, if we give you the metrics for your price to sales in the benchmark and your price to EBITDA, every 90 days we can apply those to see where we're at. We can not only look at the last accounting report that was done on an annual basis or tax filing, but we can also do it with 12 trailing months and get a very, very similar comparison. Not only that, but then you begin to see where you are each quarter in comparison to other quarters. And do you have a cyclical sense in your business? Are my sales higher in the summer and lower in the winter? Don't know. Oh, well, we need to go through and assess that because we have to make decisions about value depending upon where we're at. At the same time, we need to look back over the last 90 days and all those rocks that we assigned, those projects, did they get done? If they did, great. If they didn't, how do they affect what we plan to do in the next 90 days, which is the second piece we have to look at? Because we may have to put some of that on hold because those rocks were important and had to be accomplished first before we could get to the next step. Ultimately, though, we also want to make sure that we're looking out over that 1 to 2 year period. Why? Remember, we talked about the SWOT, we talked about the threat, and what's happening with technology and regulatory changes alone bring that into more near term than it ever has existed before. So we need to understand how that affects what we're trying to get done. Ultimately, then, we've got to measure our risk. We need to also know that there is information about our particular industry. The Risk Management Association publicizes every quarter updated information about your particular industry. It does it through the North American Industrial Classification Code. It also breaks it down into dollar sales bandwidths or possessed asset bandwidths. The dollar sales bandwidths, which are most common used for the comparable, that 0 to 1 million, the 1 to 3 million, 3 to 5 million, and the 5 up to the 10 to 25. So we got variable elements and we've got X number of companies that are all reporting in. Where does the information come from? If you have a loan, you more than likely have a covenant that requires you to, at a minimum, provide your taxes on an annual basis. You're probably also supposed to provide financial statements. The lender takes that, lines through your name, marks it out so you can't see it in your EIN number, and then forwards it to Philadelphia to the headquarters where the Risk Management Association is located, and they publish the information. So with that, then, we also need to know that we need to look at the returns on investment. What do I mean by that? Well, obviously the return on investment, the money put in and what you're able to take out and provide back to yourself, okay? But we also have a return associated with the assets and a return associated with the equity. The money you own, but you left in the business. You didn't pull it out. Why? Well, remember cranking the handle. We want this to go faster and faster. We might need more working capital to allow that to happen. So to do that, we've got to own more, or we have debt that we have to borrow money and put in, except we incur an additional expense in the form of interest, and that principal has to be paid back at some point in time, whether that's typically a term loan where we make monthly principal and interest payments, or it is a line of credit that in most cases you have a zero balance once every 12 months requirement that's out there. So that means that once a year you got to bring it all the way down to zero. So with that, then we're going to use this concept of value acceleration methodology, and we're going to constantly measure our increase in our value as if we were going to go to market. We haven't made the decision to go, but we want to still know where the heck we are. If you don't look at it this way, all the hard effort you're putting in is on a hope and a prayer that you're going to do the right thing and it's going to result in the right value that you're expecting to get. It's this methodology that we apply that gives you a much better sense of where you're going. We also will apply this against your rules of thumb that might exist for your industry. Again, comparing and understanding what that means. And we also have to understand this concept of goodwill. Every business has to exist to create goodwill. If you're not creating goodwill, you're creating ill will. Ill will is declining the value of the business. Goodwill is growing and increasing it. Some industries that are very mature, the goodwill may be sustained. It may not rapidly go up over time, okay? So we need to understand that and make our decisions accordingly. Okay, the review and analysis then wants to concentrate on this idea of making this forecast once a quarter. Look it out. What's going to happen? Who am I going to do what projects with? Who am I assigning that to? Who's going to work on it? What do I give them as measurables to determine did they accomplish it or not? And what kind of resources did I have to give them to get it done? What do we have to buy? What kind of additional labor do we have to bring in? Whose additional overtime were necessary to accomplish that over and above what we were doing on a normal expected day-to-day basis? All those decisions are made in a focused concept where once you start this, you have to continue to do this. If you don't, you lose it. You stop assessing where you are and what progress you're making towards the value improvement that you have as a goal to say, I need to reach this, and then I can go to market and get on to the next adventure, whatever that might be. So we have to understand that the way we communicate is, yes, it's in numbers, but it's also in writing. The confidential business profile story that's in there should match what's happening in our income statement, balance sheet, and our cash flow and statements of retained earnings. Okay? Why retained earnings? Showing and demonstrating that I paid a distribution and dividend to me. That's what that does. At the same time, we want to compare ourselves against the industry, not only in whole dollars, our sales, our expenses, and in the assets that we have, so much in cash, so much in receivables, inventory, furniture, fixture, and equipment, net of depreciation, and our other assets that we might have in investments, along with our liabilities, both short-term, long-term, and then most important, our equity. Are we growing our equity? Meaning, do you own more and more of the business each quarter that belongs to you rather than to the lender that you borrowed money from? Okay? Because if you sold at that immediate point in time and 80% of the assets were in long-term and short-term debt, if you sold the business, you only got to keep 20% of whatever it sold for because you had to pay everything else off to give clear title. So it's important that we understand that mix and why that's so important to us. Because if something happened and you needed to get out, would you be able to do it and accomplish what you wanted to accomplish? Okay. Getting to this concept of saying, all right, we've gone through the growth, we've gone through the improvement, and now we're able to sustain and maintain this growth rate that we have. And we've broken through to this next level. And we've got our comparables with our industry, and we're on the rise. And we're doing well against the economy. So maybe I'm thinking that, maybe this is the right time to go to market. And I make the decision to sell or to continue to grow and improve. I'm going to do that when I'm getting good indicators from my return on investment, my return on my assets, my return on my equity, and my individual rates of return on other investments that I might have put in place. What particularly are we talking about? You may have opened up new lines of business that haven't come to a maturity yet. They're still kind of quasi in the research and development, but they're ready to launch. You've done some preliminary market tests and it's about to go. Do you want to stay that next 5 to 10 years to get it to fully blossom? Or are you going to sell it as a package that the next investor can take to that level? All things that you get to decide. You do that based upon the metrics that you align your price to sales to your price to EBITDA coming in at nearly the same value, because that's the value then that more than likely you'll accomplish when you go to market. So we have to understand how the metrics work. We can get them out of line. My loss leader example that we talked about before. Okay. The other thing that you have to understand is this concept of the buyer, right? You can have all this stuff done, but if you can't find a ready, willing, and able buyer, now what? Well, we have to understand what they should be motivated about. We have to be able to entice them to be willing to do due diligence, and then ultimately after they do due diligence, to actually make an offer, see it through closing, and buy our business and clear any post-transactional requirements, right? Then it's all gone, and the money that you receive is now all yours, to include whatever your tax plan might have been through that transaction. So when you work that out, you use models to project that. The model that we like to rely on is the actual business transaction model. What is that? Well, it involves a lender and whatever the market requirements are. In selling a business today, somebody has to have the right knowledge, skills, and abilities, or a way to obtain them in a very short period of time for a lender to say, yeah, they're qualified, we're willing to take the risk to loan them money. They also have to have assets. Cash is normally good. It's the best thing for them to have. Typically, a lender is looking for a 20% to 30% equity infusion. Split the difference, 25% for a qualified buyer. It's not enough for them to have that cash. They have to be willing to use it. Some buyers may come with a combination of cash and they have equity, income producing properties that they've paid some of the debt down, and they can borrow more money against it and apply it to their portion of the injection that has to happen to meet the lender's criteria, so he'll loan 75% of the value, right? So under that concept, that's all good and well, except we have to remember that there are other pieces that also have to work with that model. One, that buyer, if they're going to work in the business or they're going to hire a manager to work in the business and operate it in absenteeism, that individual that's working in the business has to be paid at market rates. So what's the market rate for the small business owner that's operating it? Okay, we have to go out and look and compare and find out what that is and utilize that value. We also have talked about before too, as you understand a little bit better perhaps, that cash flow, you're taking it with you. So they've got to have an immediate replacement. Think about this. The night before, you go to the bank and you take all the money out of there. You take all those accounts receivable and you're pulling all that away and you pay off the liabilities. The buyer comes in that next day and says, yep, I'm buying it. He signs on a dotted line, hands you money. He gets debt. Is there anything in the business? No. He has to put the cash back in to keep that flow going on, right? Normally it's part of his bank package. So you have to account for those dollars to be in there, either injected by the buyer or the buyer's lender to make that work. At the same time, we also have to look at and assess What kind of new equipment might we need? That too has to be included in the process. Buying a new business, even though it is pre-existing and operating, is a high-risk venture. Most people don't understand the risk associated and or the reward that's demanded by a prospective buyer. That rate is going to be somewhere in that 18 to 35%. What does that mean? Pick the middle, 25%. In that 25%, that means that the money they inject, in 4 years, they're going to get it all back. That means they have to be able to crank that handle around and around, going from cash to the cost of goods, to sales, to receivables, back to cash, sufficient amount to come back over and pay all the bills for the organization, and then have enough left over at the end of the year to be worth 25% of what they put into it. That's what that means. And you have to understand how that works and get that into your head so that you can then orchestrate this to happen and get your organization aligned and in support to help you get there. So with that, then, that's partly when we can get a maximization out of that model that helps us make that decision. It's time to sell, go to market. We talk about this value maturity index. It supports some of the things that we talked about throughout this process. The first part is identify the assets, right? We need to know what's cash, accounts receivable, inventory, furniture, fixture, equipment, liabilities, equity, right? We got to understand all that. At the same time, the physical things that are there. So if you buy a business, where is everything? Well, if you're buying a transportation business, for example, that probably means stuff's moving all over the place. So on the day of closing, you either shut everything down so you can count every single one of them and see them by eyeball, or you have to come up with some other system that you're going to measure to say, yep, I have all that stuff. Okay? Ultimately, though, once you understand what you have, you need to be able to protect it. How do we do that? Well, a lot of people think, oh, yeah, okay, we got to get insured. That's just part of it. That's just to replace it in the event something bad happens. And that insurance model shouldn't just be applied to desks, furniture, fixtures, and equipment. It should also be applied to key people, because you could be hurt twice as bad as the loss of a major piece of equipment than you could as the loss of a key employee. When we go through the process and we're comparing ourselves against our company historically, we're comparing ourselves against our industry and against the economy, we're starting to get that sense that we can begin to build. Ultimately, once we go through and we get to the build stage, now we have to figure out through our SWOT assessments, do we shore up weaknesses? Do we go after opportunities? And we're able to get to a new operating level, and can we get there and harvest some of the rewards? We're watching our ROI, our ROA, ROE, and IRR increase. We're seeing that happen. We're getting that through that entire model. When we can sustain that at a continued basis, then we're up managing at the optimum level that we're targeting ourselves for. That's when we make the decision, time to sell. Okay? So as you go through these steps that identify, protect, build, harvest, and manage, you are not only increasing the business wealth, but your personal wealth, because you're making your business attractive and you are ready to take it to the market. And you have something that is competitive and compelling to attract buyers to commit to do due diligence, then to go to the next step and make the offer, go through the contingencies of totally understanding and acquiring the business and either owning and operating themselves or integrating it into an existing business that they already previously owned. With that, then, you're able to say, okay, I am in fact ready to get to the market. Under this concept of going to the market, you have to understand that every business is unique. Well, you just said, no, wait a minute, you find other industries you can compare me, or other businesses to compare me with. That's true. But within that, they're still unique. And where do they operate? We're small business. You know, if you're a lot like me, you're operating in a rural tertiary market. Some of you may be operating in a major metropolitan area. And if you are, it's different for the types of buyers for that in the major metropolitan area than what it is in a rural tertiary market. Rural tertiary market doesn't have the luxury of having 1 million people within 10 square miles. Okay, this just doesn't happen. That may be the case within a major metropolitan area by its very definition that that's there. So you have the opportunity, but you also have the threats from competition as well. I may be a sole proprietor or a sole operator, out here, and might not have a lot of competition, but I've got to travel a lot of miles to get to the same number of people. So I incur more operating costs in carrying out my services or products to getting them to market. So it's a balance, right? So that's what makes you unique. It makes you different than all the other competitors that you might have in your industry. At the same time, we need to understand due diligence. There is buyer due diligence. I think that's obvious, but there is seller due diligence also. You need to make an assessment that the individual that you are going to turn your legacy over to, even if it's an all cash deal and he's got a banker, you still have made this progress and you have worked with those employees, you have worked with those suppliers, you have worked with those customers, and you have built this pulse of providing a service or product that has a demand, and you have accomplished some success. You don't want to just sell this and say, hey, I don't care what the heck happens to everybody else. Very few people operate that way. Most people will want to, one, enjoy the fact that they are that 20 to 30% that are successful in selling, and two, want to be that 1 out of 4 that has a great legacy after they're gone, come back once in a while for coffee and be welcomed rather than spat upon or, dirty looks. You want to be able to do that in a way so that you feel good about it. Because remember, operating this business, this life business balance, after you're no longer doing the business, your memories of it still are there and they contribute to your health. So it's important that you manage that process throughout. All right. Once we've gone through, we've got a successful transaction. Now we have to make sure that we're ready for the next adventure. That next adventure depends what you want to do. Do you want to go back into business, or, at some point like me, I've got to retire, right? Because that's the thing that I should be looking forward to. Things that I'm going to do with my family and my friends after I'm no longer working this business on a regular basis. So with that, I'd like to thank you. Hopefully you found this informative and gave you some insight as to how you can go about buying, improving, growing, and selling your business, and what you need to do to prepare for that. This process of selling is a strategic element. If you do it right, then you'll have what you need, you recapture and growing your personal wealth to get you to your next adventure. Thank you and have a good evening.